In this video, we want to cover the short topic but important topic of push-down accounting. This is covered in your textbook in Appendix B of Chapter 2. In earlier editions of the book, it was a regular part of Chapter 3. I'm somewhat bewildered why the authors would move it to an appendix and put it at the end of Chapter 2. It would make more sense after Chapter 3, once everyone has done worksheets that include SAID and E. I believe this is a topic that graduates with accounting degrees should be aware of. You can see on the screen, this is a publication. You can find it online, put out by Big Four accounting firm PricewaterhouseCoopers, discussing for their clients what push-down accounting is and how it should be used. Now, this document that you can find online is 8 pages long, but even that is more than I think you need. I think what you're going to get from your textbook and from this video is enough to make you sufficiently knowledgeable about the topic. So let me give you the basic idea of what push-down accounting is. Let's look at the introduction to this problem we did in class last time. Problem 28, this was where we did a worksheet from Chapter 3, Patrick and O'Brien. If you haven't redone this one since class, you should. Doing worksheets is very mechanical, so you want to practice until you are very efficient at it, because you will do one on the midterm. Thinking back on that one, at the start of the problem it says Patrick acquired O'Brien, and then they give you this table where they say some of the assets of O'Brien are actually worth a different amount than what they are on O'Brien's statements. So in our worksheet, we handled that with an A entry, right? We figured out the excess, we figured out how much goodwill there is, and when we got to the worksheet, we allocated, A stood for allocation of the excess, we allocated that excess, and the E in the SAIDE was to remind us to do amortization expense. We didn't do it on the trademarks because that had an indefinite life, but we amortized the customer relationships. We amortized the difference on the equipment. So the fact that there were differences between book values and fair values caused us 2 entries on the worksheet, the A entry and the E entry. Push-down accounting gives companies a way to not have to do the A entry or the E entry. And the way you do that is you order the subsidiary to change their own general ledger to put the fair values into their general ledger and replace the book values with the fair values that you tell them those numbers. That's the idea of push down, right? You are the boss, you are the parent, you push down the numbers that you want onto the subsidiary's book values. You might say, well, how is that legitimate that they can do that? Well, they discuss this in the appendix to Chapter 2. It's the idea that there are now new owners of O'Brien. So in a sense, O'Brien is like a new company that just got created, and it should be created with what the owners paid for the assets. And the owners, Patrick in this case, paid fair values. So that in a nutshell is what push-down accounting is. It's a parent buys a company that's will now be a subsidiary. There are fair values that are more or less than the subsidiary's book values, and the parent just orders the subsidiary to change their books, their general ledger, to match what the parent wants. Why do it? It makes the worksheet easier because you no longer need an A entry. There will no longer be excess to allocate, and you won't need an E entry because there won't be any excess to amortize. The book only gives you 2 problems on this, and I also worked it into the Chapter 3 quiz. You have to go back to Chapter 2 for this. I did build it into the PDF for Chapter 3 problems, but they're actually from the end of Chapter 2. Number 37, what is push-down accounting? So pause the video, answer this question for yourself. Okay, hopefully you got it right. The answer is C. A said a requirement that a subsidiary must use the same accounting principles as a parent company. That's incorrect. If you rewatch the first 3 minutes of this video, you'll find I never once mentioned accounting principles. Letter B says inventory transfers made from a parent to a subsidiary. Nope, has nothing to do with inventory specifically. Again, never mentioned the word inventory in the first 3 minutes of this video. Letter C is correct. It's a subsidiary's recording of the fair value allocations as well as doing the amortizations, right? The subsidiary is going to do the allocation of the excess and the amortization, so it will no longer need to be done on a worksheet. That would be a time saver. Letter D is wrong. D says the adjustments required for consolidation when a parent has applied the equity method of accounting for internal reporting purposes. No, has nothing to do with that. So then it gives you this problem 38. On May 1st, Burns Corporation acquired 100% of the outstanding ownership shares of Quigley Corporation and paid cash, $710,000. At the acquisition date, Quigley's book and fair values were as follows. So this is the company we purchased, Quigley. They give you one column for book values and next to it a column for fair values. So you would want to look for differences because those differences would need to be allocation of the excess, and also, depending on what asset it is, might need to be amortized. Let's skip down a little bit lower. Burns directs Quigley to seek additional financing for expansion. So they're just setting up a fake scenario here. The idea is we, Burns, have told the subsidiary, hey, I want you to go out and borrow money. So go to a bank, show them just your own financial statements, right? Just Quigley. So consequently, Quigley needs to prepare financial statements separate from that of its parents. Quigley elects to apply push-down accounting, right? So you don't have to do this. This is an election that companies can do if they want to. It is irrevocable. Once you elect it, you have to stick with it. Quigley elects to apply push-down accounting to show the most recent fair valuations for its assets. And then the problem wants you to prepare a balance sheet just for Quigley using push-down accounting. Well, it's really not very complicated. You go back up here and you're going to prepare the balance sheet, but using only the fair value numbers, because Quigley would have changed its book value numbers to match the fair value numbers. So for cash, there's no difference there. So you go on the balance sheet, cash 95. Receivables, no difference. Receivables 200. On a balance sheet, Quigley would now report inventory at 260. Land would be lowered to 110. Buildings and equipment report at 330. Patented technology, which wasn't even on the balance sheet originally, will now be on Quigley's balance sheet at $220,000. Accounts payable don't have a difference. If there was a difference, you would use the fair value. Same with long-term liabilities, but there is no difference. They stay at $510,000. What about the stockholders' equity section? Well, we are making it look, right? This is Quigley's balance sheet just for themselves. So that you will leave their common stock on there and their additional paid-in capital. So here's what's interesting is you get rid of their retained earnings, because the idea is, in a sense, that Quigley is now a new corporation. That's why we updated everything to fair values. So you wipe out their retained earnings, and whatever you need to make the balance sheet balance, you make it an additional paid-in capital account. Now, one more thing we would have needed to do is also figure out how much goodwill Quigley needs to put on its general ledger. Because as we've seen in chapters 2 and 3, when the parent makes an acquisition, goodwill often exists, and that also needs to be allocated onto the subsidiary. In this case, onto the subsidiary's general ledger. So you have to figure out how much goodwill was there. Well, you go back to what we did in chapter 2. You know your acquisition price is $710,000. That's given at the start of the problem. And goodwill is the amount that you pay that exceeds the fair value of the net assets. The problem already adds up the fair value of the assets for you. That's $1,215,000. But you have to do the net assets. That's assets minus the fair value of the liabilities. So do the $1,215,000 minus the two liabilities. Compare that to what you paid for the whole thing and get the goodwill number. That also needs to be added to the Quigley balance sheet as an asset. So that is push-down accounting. It's the subsidiary recording the updated fair values reflecting what the parent company paid for those assets. Why do you want them to do that if you're the parent? It makes the worksheet much easier because once the subsidiary adjusts its records, there will be no more excess to allocate, so no A entry needed on the worksheet, and then there's no excess to be amortized. That also saves you an E entry. You might think that's not really going to save me that much time, but remember, in the real world, instead of 5 assets that need to be allocated, there could be 500 assets that have book fair value differences that need to be tracked, allocated, and amortized. So it could be a huge savings, and many companies will take advantage of push-down accounting. Somewhat interestingly is until 2014, nowhere in US GAAP was this discussed. The SEC, Securities Exchange Commission, actually had some rules about it, and it wasn't until late 2014 the FASB actually wrote it into US GAAP that companies are allowed to do that. So once FASB made it part of US GAAP, you can see it says concurrently. That means at the same time, the SEC eliminated its guidance because they didn't want to be in any kind of conflict or duplication. So once FASB wrote rules into US GAAP about pushdown accounting, the SEC knew their own rules were now redundant and unnecessary and removed them.